And good afternoon from Houston, Texas, where the weather continues to be an item of interest. I'm Randy Price, he's Matt Price, and we are the Price Group. Welcome to our monthly market update. Our goal, as you remember here, is to bring you relevant information that is with perspective and really bottom line what all this economic information means to you and in your portfolio. Who are we? We are the Price Group, family owned and operated, 50 plus years of experience. We are a fiduciary, follow the fiduciary standard, and we work in the retirement area. 83% of our clients are either retired or very close to retirement. Three advisors on the team, myself, Matt Price, and also Matthew Kearns.
So Randy's been honored to have a few awards by Barron's, Forbes, Financial Times, where Randy and I both, and Maddie as well, certified financial planners. We think education is really important in our industry. Randy and I went to Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation, and a few things we keep up with on a regular reoccurring basis with those designations. Our firm, Steward Partners, most everyone, it looks like, clients on the call, but a few visitors as well, based off the biblical definition of stewardship. Raymond James is our primary custodian, meaning that's where client assets are held. Raymond James has been a great vendor, a great partner of ours over the past 6.5 years.
Let's get started by talking about the economy. Where are we? Everybody talks about a potential recession. Our view of the world is the economy is expected to slow, but no hard landing, or as we call it here on the slide, a wipeout. It's always news when the Federal Reserve starts to increase interest rates. We've been through that, and it's always big news when the Federal Reserve starts to cut interest rates. The big question everyone is asking, how many Fed rate cuts are expected in 2024? We're going to hedge our bets and say 1 to 2 rates. There's an 80% chance the futures market shows of at least 1. So slowing inflation, some economic growth are supportive of Fed cuts. The 2024 estimate forecast for the gross domestic product is a little bit over 2%, and for 2025, right at 2% on there. Other factors that will support the economy, and again, you want sort of a Goldilocks economy, right? Not too hot, not too cold, but lowering inflation has been a goal of the Federal Reserve, and they look at the underlying factors. The consumer is boosting the economy, but the chart on the left talks about the capital spending by corporations. Corporations are going to continue to invest money, put money to work, and hopefully create jobs, and also hopefully grow the economy as well. So that is a big factor. Also, you've been reading and hearing about some of the spending by the big companies on making, from a computer perspective, how to think AI, how to make things work better, quicker, faster. A lot to be said and unpacked there, and really not something we're going to get into today, but many of the companies say they're going to spend a lot of money also on artificial intelligence, what people would call AI. So altogether, we think there is support for the economy, and not a reason to be worried or really concerned that there is a hard landing.
So let's talk a little bit about navigating the bond market. This is a question we've been getting a lot. Draw your attention to the chart there on the left. Something interesting, Randy mentioned the gross domestic product. We think it's going to slow. And remember, the gross domestic product just being a collection of all the goods and services within the country. And historically, this chart dating back to 1962, you can see the output, or the gross domestic product, has been a pretty good indicator of what the 10-year U.S. government bond is yielding. Just as a review, the 10-year US government bond is a good proxy for what interest rates are across the country. So if history continues to, history does not repeat itself, but it often rhymes. If it continues to rhyme and the gross domestic product would move lower, one could suggest that interest rates also move lower. So that would be our base case. Earlier this year, we made a few tactical changes within the fixed income portfolios for clients, but our best guess at this point, like Randy said, we get 1 to 2 interest rate reductions from Mr. Powell and the Federal Reserve. We think interest rates as a whole could move lower by this time next year.
Matt, it's also worth noting that the 10-year government bond is sort of the proxy for where interest rates are going to be for a mortgage. So if you children, grandchildren are looking at that, you can use that 10-year treasury and the movement, increase in interest rates or decrease in interest rates as a sort of a modeling tool for which way interest rates are going to be moving.
Yeah, good point as well. This bond cycle has been a little bit different. I want to draw your attention to the chart there on the right, the longest yield curve inversion on record. What does that mean? That means the yield curve is inverted when short-term interest rates, think money markets or the yield on your cash in your local bank account, are higher than the medium-term or the long-term interest rates, say the 10-year US government bond that Randy just mentioned. And you can see here over 400 days on the inversion, the longest on record. We think at some point that does revert. Historically, this has been an indicator of a recession. When you look back, you can say anywhere from 150 to 200 days. Typically, that's when you see a recession come about. Our base case right now is if there is a recession, we think it's mild. But like we said on the slide earlier, we think the economy actually continues to grow the back half of this year and early into 2025. So absent a black swan event, China dropping a nuclear bomb on someone, something like that, we don't see a recession here in the short term.
I'd always like to remind people that recession rhymes with depression, but a recession is just 2 straight quarters where the economy does not grow. And in many cases, if it's a slight recession, unless the press or somebody told you, you might not even know that. But we're talking about a soft landing is what we hope for. A hard landing would be a recession that is pretty severe. And again, we do not expect that.
Here, what we've seen for the first almost 7 months of the year, investors continue to climb the proverbial wall of worry. And a little bit of a busy chart, I want to draw your attention to the recessionary concerns. Okay, the dark blue line, the MAG, those are the top 6, top 7 stocks. They've been referred to as the Magnificent Seven. And the performance over time, they've been actually the best performing stocks for the first 6 months of this year. What we like and what we've been focused on are some of the non-Magnificent Seven, the other, call it 493 stocks out of the S&P 500. And they've done okay this year. They are positive, but we think moving forward, the other 493 actually are where we want to hang out. So that's a big piece of our dividend growth stock strategy. The non-technology specific stocks, we're actually writing a blog article we'll send out this week or next week in a little more detail on that. But we think that's actually a positive if the market gets what we call less concentrated and you see the average stock start to move higher as well. The valuations on some of those technology stocks are rather high when we look at it from a relative perspective, looking at the last 10, 20, 30 years. But there's a little bit of a bifurcation with those other 493 stocks, the stock market absent the top 6, the top 7. And you could make a pretty compelling argument that outside of those top 6, those top 7 companies, the market could actually be a little bit undervalued, which is why we like those 493, 494 stocks outside the top technology stocks.
Which is a great segue on one of the reasons we remain optimistic longer term. Current bull market is the return during this bull market has been 53%, while the average is about 60. It's been going about right short of 2 years, and yet the average duration of the bull market is somewhere in the 5.5 range. So we think, again, earnings continue to move higher, still positive economic growth. There's a record amount of cash on sidelines with people trying to decide good time to invest, bad time to invest, run for the hills, make additional investment. And then if interest rates do move lower and inflation does move lower, that can help stock prices as well. So again, we do remain optimistic for a longer period of time. But we do expect volatility going forward. As Matt pointed out, there, the top 7, the Magnificent 7 is what we'd call a top area market, top heavy market. And we think some of the areas other than that Magnificent 7 are going to benefit as the market broadens out. Industrials, healthcare, energy, small stocks have just recently, after a long slumber, have started to move. And again, on the left-hand side, as Matt was talking about, you can see the Magnificent 7, the Magman, up almost 45%. So anyway, trees do not grow to the sky, and we do expect a change, but volatility going forward.
Another question we've gotten quite a bit over the last month or two has been, what are our thoughts on the U.S. compared to the rest of the world? And it's a great question. I've been doing this with Randy now for 14 years, and for 14 years, we've been really actually overweight U.S. stocks opposed to international. At times, we've added a little bit international to the portfolio here and there, but we continue to think that the U.S. is the cleanest shirt in the dirty laundry. For a handful of reasons. You can see the innovation index, the entrepreneurship index, 8 out of the 10 top companies in the world, a few other designations as well. Part of that has to include that the US dollar is the world reserve currency. So that is a slight wind at the back for US companies. The thing we feel really comfortable, though, with having more of a US focused is a lot of the companies that clients own in their dividend growth portfolio, in their core growth portfolio, have multinational revenue streams. So while the company is domiciled here in the States, they are picking up 10, 20, 30% of their revenues from Europe, from Latin America, from Africa, wherever it might be outside of the US. So it's a little bit of a backdoor way to get some international exposure. But here, for the second half of 2024, going into 2025, we continue to be comfortable with a U.S. overweight. Just companies in the U.S. have been, and we think will continue to be more profitable in the short term.
Hope this is not news to anyone, but we have an election coming up this November. The polling suggests a tight race. 59% betting probability that the Republicans will win the White House. And you can see some of the swing state information there. And it ought to be an exciting remainder of the year with regards to that. So as we look at the election coming up, our takeaway from that is avoid the political noise when investing. You know, there's some of these sayings that have become sort of ingrained, but many times they are totally accurate. But a broken clock is wrong 2 times a day. Politics not at the top of the investing framework. Economic growth, earnings growth, monetary policy, interest rates and inflation, valuations, sentiment, corporate activity, and number 8 on the list, politics, natural calamities, and geopolitical events. So staying invested typically is a way to win for every person that you talk to, and they got out right before the market pulled back. And as we've talked about many times, pullbacks are a normal and a very healthy part of market movements. On average, the market's down about 10% once a year. On average, once every 3 years, it's down 20%. So there's an ebb and flow, a tide in, a tide out. But again, performance long-term can really be hurt by getting out and being on cash when the market does recover. So you can see the chart there. Fully invested, only invested under Democratic president, only invested under Republican and under Republican president. So we would say don't let the politic tail wag the dog with regards to investing. So that ends our prepared remarks. Matt, questions from the participants?
Yeah, one question came in here. What is your opinion regarding the national debt and the amount of annual government payments being almost half of the current GDP? It doesn't appear to be sustainable. Randy, I'll let you take that one.
So the government is spending way too much money, and the U.S. government and our leaders have to find some way to get this under control, or it is a cancer that will wreak havoc on the economy. You can either grow your way out, or combination of grow your way out as well as try to cut spending. Cutting spending has proved much harder than most people thought it would be, and so remains to be seen. But it's part of the overview that we look at from making investment decisions on stocks as well as fixed income. But we do appreciate your time. Please feel free to reach out with questions, with comments. The team there, our newest team member, Preston Price, Tiffany, Maddie Kearns, myself, Matt Price, and Melissa. So anyway, our phone number, contact information on there. Again, if you're not getting our weekly commentary, we think that's also of value in addition to these monthly podcasts. So again, we'll look forward to seeing you next time. Stay safe and have a good rest of the week. Take care.